Listen up, because this is important. A trading gap is like a mystery novel. It's a space on a stock chart where the price jumps up or down overnight or during the trading day. Imagine going to bed with a stock at $50 and boom, it opens at 55. That's a gap up. The opposite, a gap down, is when it opens lower than the previous close. These gaps tell a story, folks. They scream that something big might be happening with the stock. Maybe there's huge news, a surprise earnings report, or even just a rumor mill churning. Whatever the reason, gaps are like flashing neon signs for traders. But here's the thing about gaps. They don't always mean you should buy or sell immediately. Sometimes they fill quickly, meaning the price goes back to where it was before the gap. Other times, they signal a real shift in the market. That's why we gotta understand the different types of gaps and what they mean for our money. There are 4 main types of gaps, each with its own personality: common, breakaway, runaway, and exhaustion. Common gaps are like that friend who always shows up unannounced. They happen often and usually don't mean anything major. They're small and tend to fill quickly. Think of it like a blip on the radar. Breakaway gaps are more exciting. They happen when a stock breaks out of a trading range, like a racehorse bursting from the starting gate. These gaps often signal the start of a new trend, up or down. Runaway gaps are like a runaway train. They keep going and going. They happen in the middle of a strong trend and show that the momentum is still strong. If you see a runaway gap, hop on board or get left behind. Exhaustion gaps are the tricksters. They happen at the end of a trend and signal that it's running out of steam. Imagine a marathon runner hitting the wall. These gaps often lead to a reversal, so watch out. Now let's talk about why these gaps appear in the first place. One word: news. Earnings reports, analyst upgrades or downgrades, even a CEO sneezing the wrong way can cause a stock to gap. Overnight market activity is another culprit. When the US market is closed, other markets around the world are still trading. Big moves overseas can impact US stocks when they open. Then there's the basic law of supply and demand. If everyone suddenly wants to buy a stock and no one wants to sell, guess what? The price goes up and you get a gap. So, how can you use these gaps to make money? Well, there are a few strategies. Gap fill. This is when you bet that a gap will close quickly. You buy a stock that has gapped down, hoping to sell it when it goes back up. Risky, but potentially rewarding. Breakout trading. This is for the bulls. You buy a stock that has gapped up on heavy volume, betting that the breakout is for real. Remember, volume is key here. Reversal trading. This is the opposite of breakout trading. You're looking for exhaustion gaps and betting that the trend is about to reverse. It's like catching a falling knife, so be careful. But here's the most important thing. Context is king. Don't just blindly trade gaps. Look at the overall market trend, the company's fundamentals, and any news that might be moving the stock. And remember, never invest more than you can afford to lose.